A global ETF is one of the most passive approaches you can take with investing. It's an all-in-one product. But in this video, I'm going to show you how you can create your own global ETF portfolio that gives you greater flexibility and could also save you money on fees. That flexibility comes from being able to change the weightings of a global ETF. For example, you know you want to have global exposure, but you may look at the US making up around 60% of a global index and feel that's maybe a little bit too high for your liking. To create your own portfolio, it's a case of picking around 6 different ETFs to cover different parts of the world. You could match the same weightings as a global ETF, and then it's a case of you saving money on the fees, and we'll come on to that a little bit later. Or you could set a preference, and you could over or underweight, depending if you have a preference on a certain region. I'm going to use Vanguard's FTSE All-World ETF as our benchmark, and I'm also going to select all Vanguard funds when it comes to the specific regions. As I go through the selection criteria and show you how to select them, I'll also give you some alternatives as well. So if you want to base it purely off fees, then you've also got that choice as well. I'm simply just picking Vanguard to keep it really simple for this example. Looking at the All-World fund, we can see a market allocation where it's split out by country. But this is a little bit too granular. If we were to create an ETF for every country, we would have far too many to manage. So what we're going to look at instead is the region exposure. And you can see it split out here: North America, Europe, emerging markets, Pacific. Let's start with the biggest one, North America. We're picking North America as a region as opposed to simply picking the USA, just because we also want some Canadian exposure as well. I'm going to use the ETF screener on just ETF, and we can filter by equity to start with. And then region, we're simply going to select North America. I'm then going to select 3 other filters, and we'll use this for all of the other selections as well. First is going to be older than 1 year, accumulating for use of profit, and then larger than 100 million. This one's really simple because there's only 2 options and they're both from Vanguard. We're going to select the top one, but the only difference between that and the second one is ESG, and it's also an all-cap fund where you can look at the number of holdings and see it's over 1,400 compared to just 582 in the standard North America fund. It is more expensive, and simply because that 582 covers the majority of the performance that we need. Because it's market cap weighted, we get most of the exposure, but at 0.04% cheaper. So we're going to select the top one. Our next region to choose is Europe. So we can simply change North America to Europe. And my preference here is that I want a fund that excludes the UK. That's because we're going to pick the UK separately. That just gives us a little bit more flexibility and control when it comes to the weightings. You can pick an all Europe fund, and I'm going to show you a few options here. The only 2 funds I would look at in this list is this Amundi Europe 600 fund, and the one we're actually going to choose, the Vanguard fund here. I would ignore all the others because all the ones that say stocks 50, as you can see by the holdings, it's just the top 50 companies in Europe. And we want a little bit more broader exposure than that. This one, Europe 600, is hedged, and this one is a slightly different objective. So the only 2 we're left with is an all Europe fund, and then the one that I think my preferences suits is Develop Europe excluding UK. So if we compare these 2 funds by looking at country by weighting, you can see in the European fund that the United Kingdom makes up just over 21% of the fund. So it's the largest country by weighting. It's not a massive majority, but by choosing the Vanguard fund, which excludes the UK, it just gives a little bit more weighting to the other countries like Germany, France, and Switzerland. So now let's choose a fund for our UK exposure. So I'm going to take Europe out of the region, and I'm simply going to select United Kingdom in country. That gives us 11 results, but there's only 3 that we're going to look at. Legal and General UK, we see BlackRock iShares FTSE 100, and also the Vanguard FTSE 100. I'm going to ignore the top one, the LNG fund, simply because it only has 79 holdings. When we're looking to track the FTSE 100, I want it to have the full exposure of that index. That leaves us with iShares and Vanguard. There's literally nothing to choose between these 2. There's 2 basis points difference in terms of the cost. They're both massive in size, and they're both from well-respected providers. So it doesn't really make too much difference. But for our example, I'm going to pick the Vanguard fund. And then we need to pick Asia Pacific. And I'm going to do the same thing that I did with Europe. So the first thing we pick is Asia Pacific in region. And then I'm also looking for excluding Japan for this preference. And that's because when we look at the global index, Japan makes up just under 6% of a global index. So it's a massive weighting. So by excluding it and doing it separately, again, it just gives us a little bit more flexibility. So that gives us 18 results. But again, there's only 3 that we need to pay attention to: this LNG one, this HSBC one, and the Vanguard fund one. I'm going to ignore the Franklin one because it also excludes China. And then we're going to compare these 3 funds. The main difference between these funds is the index that it tracks, specifically the index provider. The LNG fund tracks a sole active index, the HSBC tracks an MSCI index, and Vanguard tracks a FTSE index. That makes a difference because of how each index classifies different countries, the main one being South Korea. And that's because MSCI and Sole Active class South Korea as an emerging market, where FTSE classify them as a developed nation. And you can see in the Vanguard fund, which tracks the FTSE index, South Korea makes up just under 29% of the index. And because it's not included in the other two, it means that countries like Australia have a much bigger weight. And for me, when looking at Australia making up over 61 and 62% of the fund, for me, that's maybe a little bit too high of a weighting. And I'll also show you what that looks like when we look at the emerging markets fund. But for me, my preference is going to be the Vanguard fund because it tracks the FTSE index. We now just need a fund that tracks just Japan on its own. So in country, we can simply select Japan. That gives us 23 options. Similar to the UK options, this is really simple as well. We're mainly going to look at these top three. The Vanguard fund and the LNG fund, there's literally nothing between them. They both have the same cost. They're both a similar size and they both track a reasonable number of holdings. I'm going to ignore the top one, the Amundi one, simply just because it's denominated in the Japanese yen, where these LNG and Vanguard are denominated in the US dollar. That's just a personal preference picking the US dollar over the Japanese yen. And the US dollar itself has had a pretty bad year compared to some of the other big currencies. But the Japanese yen has had an even worse year. And when we look at the long-term trends, I only see the Japanese yen getting a little bit weaker. So by picking a fund that's denominated in the Japanese yen, we're going to add some extra FX risk, which we can really avoid. Now we can select emerging markets, so we can just go to region and select emerging markets. This gives us 30 results, but again, there's only a few that we really need to look at. There's going to be three that we're going to look at. This Amundi fund, this HSBC fund, and the Vanguard fund. And the choice of emerging markets goes hand in hand with our choice for the Asia Pacific, excluded Japan, because of the index provider choosing whether to include South Korea as an emerging market or not. So let's look at these in more detail and I'll show you what I mean. So similar to Asia Pacific, Amundi uses Seoul Active Index, HSBC uses MSCI, and Vanguard uses FTSE. And when we compare by country, you can see both the Amundi and HSBC funds have around a 10% weighting toward South Korea, where because South Korea is included in a developed nation for FTSE, the Vanguard fund then doesn't have South Korea, and therefore some of the other countries like China, Taiwan, India, Brazil have a slightly higher weighting in that fund. So it really comes down to which combination that you prefer. In terms of weighting, you'll see that South Korea is only 10%. You might remember that in the Asia Pacific, excluding Japan, South Korea was up around 28%. Is actually a lot closer than that because emerging markets make up just under 10% of a global index, where Asia Pacific, once we take out Japan, is closer to around 4%. So if you were to weight this in the same way that a global index is weighted, then actually South Korea is fairly similar. So there's really not too much to choose between these. Again, just a preference. So these are the 6 ETFs that I've chosen for each region. I've sorted them by their global weighting, and I've also included their fund code, their TER, and also the last year's performance. So if you want to pause the video here, do that now. Once you get to this point, you can then choose what preferences you have in terms of weightings. You can simply just match a global index. You will need to rebalance it from time to time because the global index is market cap weighted. Depending on how each region and how each country performs, that will slightly change. There's no right or wrong in terms of how often you rebalance it. Around 3 to 6 months is probably preferable. If you do want to have a preference in weightings, you can then choose which regions you think might outperform and then overweight those and then underweight the ones that you think might be potentially a little bit overvalued. I think the most obvious one that people will look at is there's such large weighting in North America. So if you slightly reduce that global weighting from 65, you can then spread that out across some of the others. You might look at the UK, it's only 3.5%. Is that slightly undervalued, especially compared to the rest of the world? Do I slightly overweight that compared to a global index? Depending on other big nations, you might look at China and think that they've got more potential in the next 5 to 10 years. They come under emerging markets, so do you slightly overweight emerging markets? And then depending on your weighting is also going to change the average TER. So if you just base it on the global index right now, the average TER for this portfolio on screen here is around 0.095%. That's compared to Vanguard's FTSE All World Fund with an ongoing charge of 0.19%, and even one of the cheapest All World ETFs on the market, the SPDR MSCI All Country World ETF, with an ongoing charge of 0.12%. That saving in fees is important, but I'd say the most important thing is just going to be down to your preferences and how active an investor you want to be. Picking one fund, a global ETF, is so simple. You don't have to pick any sector or region. You don't have to rebalance. You just set and forget. By going down this route that I've described today, you're picking 6 ETFs, gives you the flexibility, allows you to potentially beat the market, but you also then run the risk of also spending more time in rebalancing, and you also run the risk of underperforming the market. But that's all part of the fun, right? Let me know your thoughts down below in the comments. Hope you found that useful, and I'll catch you in the next one.